people who are trying to buy a piece of real estate. It needs a ton of work, a build. Amy has some creative financing.
Couldn't believe how many multifamily operators are in serious trouble and we're going to be bailed out.
All that we do is real estate investors who want to fix and flip, buy and hold, ground up new construction, or if they need to get into the multifamily space. And we don't care about your tax returns. I will never ask you for one. And we don't care about your debt to income. And there's no limit as long as it makes sense. We write individually to each project.
280 banks stand to be out of business in the next 12 months across the country. And
Wow.
Some of them are very, very large names.
Welcome everyone to episode 20 of Blueprint for Closers. I'm Dominic Ciccarelli with Think Design Architecture with my co-host Rob Nixon from Pre-Real. What's up, Rob?
How you doing?
It's a beautiful day in New York. Today we have the beautiful Amy Martinez from Lima One Capital. Thank you for joining us today.
Thank you for having me. I'm happy to be here.
Today we're going to be talking about people who are trying to buy a piece of real estate, but it needs a ton of work, some renovations, a build, and how Amy has some creative financing on how we can roll all that up into a loan and get you under construction. So without further ado, Amy, why don't you tell us a little bit about yourself and where you grew up and who is Amy?
All right. So I am an interesting character. I think that if you actually sat down with me and talked, we could probably talk about my background and what I've gone through for hours. And then by the time you were done, you wouldn't be bored. You would be absolutely like, write a book or something. I've been told that multiple times, but my name is Amy Martinez. I am originally from the state of Montana. That was where I was born and raised, and I actually went to school there as well. I graduated from the University of Montana. I started in school with a business degree and ended up not wanting to get into accounting. So I decided I got all the undergrad stuff done, or not the undergrad, the basics for accounting. And then I switched majors. And now I realize as an actual adult, I thought I was an adult then, but I wasn't, that I should have probably just finished the accounting courses and get my business degree, because after changing my majors 3 or 4 times, I decided I just was going to graduate with whatever was the easiest. And that ended up being communication studies, which is the most broad degree with no actual job in mind that you could possibly get outside of like maybe psychology, even though, no, I say psychology has more of a niche. So that's what I did. I graduated. I took a year off. I had actually was putting myself through school. So I was in the service industry. I actually was a waitress, bartender, restaurant manager for over 10 years total. And I kind of hung out for a little bit. And then I said, hey, I need to get out of Montana or I'm going to be stuck here. No offense to anyone who's from Montana. I can say that because I am. But I was like, I got to get out of here. So I decided to get on a plane. Literally, it was no drama, nothing behind it. And I flew to New York after finding a job, and have been in New York State ever since. That was about 2008, and that's where I've been. So I'm currently in the Hudson Valley. If anyone's familiar with New York, it is not the city. It is not upstate. It is the Hudson Valley, and I've been there since 2008.
I gotta maybe correct you, because although you thought you might feel stuck in Montana, Yellowstone, the TV show, is driving everyone out west now to become a ranch owner and getting into ranching and cowboys. Talk to me.
I was going to ask your take on that. Are you not a fan?
No, I am not a fan. And not that there's anything against it. There's some quality actors in that show. But it's Yellowstone, and honestly, most of Yellowstone is in Wyoming, so I have a hard time with that. And then second of all, there's 2 major state parks, or major parks in general, in Montana, and Glacier is by far tremendously more beautiful. And that is one of the only places in Montana that I miss. If I could go back every year or whenever I go back, that is what I try to see. So I have a little bit more of like a soft spot in my heart for Glacier over Yellowstone. And then it's Hollywood. So it's never going to be real. You're never going to see the real thing.
But did you grow up like on a ranch, or you were in a city?
No, I grew up in there's more cows than people in Montana. So the cities are very small in comparison to where we live now. I think maybe 80 to 100,000 when I was growing up, which was big back then.
Wow.
It was still one of the top 5 cities in the state. And you can fit, I think, 2.5 New Yorks, like space wise, in Montana as far as space. So lots of space, not very many people, which some people love. Personally, I wanted to be where things were happening. So that's why I had to get out of there.
To give perspective, in your graduating class in high school, how many people graduated?
Okay, that's a trick question. So not many people ask me this question, so I don't have to be honest about it, but I was actually homeschooled.
Okay.
So my
Wow.
graduating class was me, technically.
Okay.
But because I was homeschooled, I was also able to go to the community college like early. So my last 2 years, basically of high school, I was going to like actual college. And then there's a homeschool association. They have a graduating thing that they do. But
Yeah.
yeah,
I know a ton of people. I know a ton of people, especially during COVID, that homeschooled.
sure.
And homeschooling is becoming much more common, even here in New York City,
Yeah.
because of the policies in school. The parents just don't agree,
Mhm.
and they rather homeschool. And you're right, there is a community, because I have a friend of mine across the street who homeschools their child. And after I'm like, well, who do you engage with? Who do you play with? And there is a whole community, especially now with social media and Facebook groups.
Yeah.
There's a whole community of kids. There's just within 2 miles from here
Yep.
that are all homeschooled, and they act as one big class, and they do coordinate trips together and play after school and things like that.
Yeah.
I'm New York City public school trained. My graduating class was 1,200 people.
Wow.
Not the school, just that
The
class.
class. Yeah.
Yeah.
Incredible. Yeah. I don't even know what that's like, to be honest with you. I don't even know if my class, I should look back when I graduated from University of Montana. I don't even know how many people graduated that year, because our school at the time only had about 14,000 students, which was a lot for Montana. I don't even know. That's a good question. I have to look back and see. I'd be curious to find
Were
out.
you home? Not to dwell on the subject, were you homeschooled all through elementary school, like from like birth to high school, or were there
Yes.
times you were in school?
Yes. So I'm actually, another fun fact, the oldest of 6 girls that I was raised with. I have an older brother I wasn't raised with, but the oldest of 6 girls that I was raised with, my mom homeschooled them all. So I was, yes, in school with her from the beginning. She's a certified teacher, still is. So we had like a little bit of a professionalism there. And then also that was one of the things that she recognized when I was in high school, and she continued with the rest of the girls. Like, I'm not going to be able to teach you all these courses. So that's when she put me in the community college for a lot of like the higher math stuff and some English courses, that sort of thing. And it ended up working out well, because when I went to the University of Montana, I had my freshman year done already. So it was nice.
Wow. I got to say, homeschooling did take place during COVID, and moms and dads were now trying to do the curriculum, and it's super difficult. It's way harder than I thought it would be.
Yes.
And it's really hard to separate mom and teacher, or dad and teacher.
So hard.
And you're spending the mornings or a good part of the day doing school, and then it's hard to shut that off, and then all of a sudden become mom or dad afterwards.
Yeah.
So we might have to do a whole episode just on this, because it is becoming more and more common, and it's a struggle for sure.
Mm-hmm.
Why don't you tell us about, once you got to New York, why finance? Like, why that direction?
So I consider my career in finance almost like on accident. I had moved to New York, briefly did a small stint as a nanny. That was kind of the way that I got myself here, but it was never meant to be my long-term goal. It's just an ends to a means, basically, or means to an end. And I stupidly, I always call myself young and dumb, fell for a recruiting, what do you call it, stitch or whatever. Like, it was basically really, really, really brilliant for people at my age who didn't know any better. And now, mind you, this is 2008. So I also had no idea that we were going through a housing crisis, that a financial crisis in general. Like, that's how, what I call myself, young and dumb, I was. But I fell for this like really like targeted ad, so to speak. We didn't have them back then, but for an insurance firm, unfortunately. And it sounded amazing. It sounded like I was going to make all this money. I was wanting to like, boost my life, do something fantastic. So I fell for it. I got involved in an insurance agency very early on. And it ended up being one of the hardest things I've ever done because there's a 99% turnover in insurance because of how difficult the field is to like progress, especially in the first couple of years. But I had moved to New York. I was by myself. It was me, my cat, and an air mattress. Like literally that was it. All my stuff that I had back in school was still in a storage unit back in Montana, and I wasn't going to move it because I had no idea what the heck I was doing with my life. And I got into this insurance thing, and it was hard. Like that was where I learned to like really grind and hustle. I was making up to 500 calls a day. We were using like just the dialer. We didn't have automatic dialers back then. Not that I use one now, but people use them nowadays. Like you were literally pushing every single button and you were calling someone hoping to get an appointment, and you weren't leaving the office until you had your schedule booked. And it was my only, outside of like the waitressing, like I said, I started waitressing to kind of supplement myself, or continued because I'd done it in Montana. I had to make it work. I didn't have a choice because I had bills to pay. And the cyclicalness of that income was just very draining, especially when you don't have anything for a backup. So I stayed in insurance, but I switched companies for a little bit more of a security. They gave a little bit more offerings. They were a little bit more well known. And then at the second company I went to, I actually got my securities licenses. So I was working to be more of like a registered rep, so I could do like variable annuities and all that jazz as well. But I still it was just so stressful. And anyone who like knows or has been in that type of a job, they just know like it is a lot. I got into trouble with the IRS because I wasn't able to pay any of my taxes. My accountant at the time was like, I was like her mess that she had to deal with. And I was like, I don't know what to tell you. Like, I got to feed my face and so I can survive. And so the government's not getting his money now. Thankfully, we're out of that. So if anyone from the government's listening, we're safe. I took care of it. I got out of that mess. But I can empathize for sure. And then I was like, I didn't know what to do next. And so I kept looking and found banking. And actually at the time, I could take my licenses and my insurance and whatnot experience, and I could move it to a platform relationship banker, basically. And so that's what I did. I moved to a bank and I sat on platform, continued to do investment and insurance and all that jazz. But that's also where I started learning about lending and just overall banking programs and like what it is that people could do. And I really enjoyed that because now I finally had a base paycheck. The relief of a base pay is I don't even know how to explain it to you, but it was amazing. So I did that for a little bit. But again, you can go back to like the Wells Fargos of the world. When you're in a banking situation, and as much as they like to say it's changed, it hasn't. You have goals, and they are not your goals. They are not the customer's goals. They are the bank's goals. And so you have to sit there and you have to sell things to people that they might not necessarily want or need. And I cannot stand that. It's one of my biggest pet peeves. It irks everything inside of me. Like I just protest. And so when my at the time boss was like, "Hey, I'm heading to a credit union," I was like, "I'm following you. I'm coming with." So that's what I did. And the one he went to was like nice and strong, and it was like, a big fan of it. So we ended up working out of northern New Jersey. That was our territory. And I got a job with him as a branch manager, actually. And that was when it was a completely different experience. No offense to banks, but credit unions are member centric and they do everything for the benefit of their members. And I finally got to sit in a position where I was doing things for people, like what they needed. And it changed my life on the finance side. Because I went to that credit union and it was newer in the area of New Jersey, they'd just recently taken over some branches there. I got to kind of help build it up. And I've always been the kind of person where I'm the guinea pig. I was the guinea pig as the oldest child, at least growing up with my sisters. And for some reason that just followed me throughout life. So the organization was like, "Hey, you're going to test this or you're going to test that." And one of the first things they had me test was being a branch manager who originated mortgages. They already were doing, and they still do, like home equity lines of credit and personal auto loans, that sort of thing. So I was doing a lot of that. But they're like, "Hey, you're also going to test being a mortgage originator," because they were starting to kind of focus on that at that time. So I did that. I did that really well. And so they're like, "All right, They made sure that all the branch managers then had access to being a mortgage originator. So I got used to doing that. And then they said, hey, since you like to take on new stuff, we're going to basically take all these different roles of the credit union that we don't have a single person for, and we can't seem to hire for. And we're going to just put it all together and make a new role, and you're going to be it. You're going to pilot it. And I was like, okay. So that was when I became what was called a regional relationship manager. I believe that was what it was called. I don't know. I can't even remember anymore. But I basically had this whole gamut. I still was doing residential mortgages. I was doing member experience. I was doing business development. I was in charge of every single car dealership in the state of New Jersey and in charge of onboarding new ones. So I was constantly going out to get car dealerships for auto leases and loans. And then there was no commercial lender in that state either. So I said, hey, you're going to do this as well. So I'm basically all these different hats, trying to increase business, really hitting the ground, like hitting the pavement, basically. I think I've driven up to 400 miles in one day before, like just burning, trying to get business going. And I did it well enough that they then duplicated that role. It's still a role they have to this day that they've like passed on to other people. And they said, hey, since you've kind of like proven the concept, so to speak, what do you want to do next? And I really liked commercial lending out of everything that I was doing. So I then transitioned into a true commercial lending role. That was kind of the beginning of the end for me. I loved the concept of it, but wasn't really the greatest place to do it. But we'll kind of leave it at that. So I'm like, I like this job. I can't go any farther in the credit union. I've kind of exhausted everything I can do down here. What do I do next? So I hired a recruiter, and the recruiter then found me this place. It was called Finance of America Commercial. Got a job with them thinking, hey, I'm going to do commercial lending. And all of a sudden it was like, no, you're actually going to do private, almost basically hard money, but for a private institution and strictly for residential real estate. So it was a completely different concept for me. I just finished I just went through all these extensive courses in like business lending for credit unions and all this jazz. And I said, no, you're going to do this. And didn't even know it existed. And I've been in this space for a long time. And I liked it. So I was like, hell yeah, let's do this. And so I was, building my business. And then anybody who knows kind of a little bit of the history of that company, it went out of business. So I had to pivot. And the year of pivoting was last year, 2023. It was a nightmare. It was one of the worst years ever, outside of when I had to hustle for pennies as an insurance agent. But I stayed. I liked this space. I am a itty bitty little like real estate investor myself. So it was like interesting to me. If I had to come back as a different person, I'd probably be a real estate attorney, minus the school. I hated school. So I'm like, yeah, I like this space, so let's find something else. And then through the process of elimination, finally was able to land a job. Thankfully, I never thought that I'd have the opportunity to work for Lima One, but I was able to do so. And I started back at Lima One in October. So I'm in the space that I like. It's the best thing I've done out of all the different financial aspects that I've touched. That's kind of like, it's a long story, but it's an interesting story. And that's kind of how like I landed where I'm at now.
I love it. So Lima One, 2.6 billion last year in sales, direct lender for private institutionalized money. What are some of and you're in business development, you're writing loans yourself. So what are some of the things that they offer? What are the programs like? What are the trends you're seeing in general? I think, viewers would really love to hear about
So that. Lima One Capital actually has a cool history themselves. I'll just kind of like focus on that for just a second. They were actually started back in 2012 by Navy SEALs, which I always like to throw out there because Lima One itself, that word, like nobody knows where that comes from. Some people say we're from Peru. Other people call us Lima. It's Lima One. We're not a lima bean. And it comes from the Navy SEALs that started us. That was actually the name of their unit. So they wanted to pay homage to that, which I think is super cool to know that we have like this veteran background.
That is really cool.
They have since retired. So they're not part of the business anymore, but we definitely kept the name to keep that legacy alive. And since 2012, we've been working exclusively with residential real estate investors. And we've been doing so across the whole United States for 46 states. So we're in 46 states currently. And all that we do is with, like I said, real estate investors who want to either fix and flip, buy and hold, ground up new construction, or if they need to get into the multifamily space, we have a stabilized bridge program or a one that has some CapEx. So if you're dealing with some bigger projects, we have a pretty unique program there as well. But basically, our goal is to help overcome traditional financing hurdles and help investors build long-term wealth through real estate investing. That's like what we've done since the beginning, and that's what our goal is going forward. Our goal this year as a company is to do $3 billion in funding, and then like I'm trying to work personally on doing over 40 million. So that's like my nut to crack, so to speak. Yeah.
That's awesome.
What would you say the smallest loan Lima One has done and the largest loan Lima One would do?
So we actually can go as low as 75,000 for a loan amount, and that's not uncommon either because there are some areas in the U.S. where there's smaller property values and smaller budgets, that kind of stuff.
Mm-hmm.
So I've actually personally written a few that are just right over that, and then the largest that we would do. Actually, it's not mine. Unfortunately, I wish it was mine, but we just were on a call today, and one of the people on my team actually got approved to do over 10 million for a new construction build out of Tennessee. So we have this very large appetite for lending. Very, whatever it is that you're kind of coming to us with, as long as it kind of fits within that realm, we have the ability to look at it and most likely do it. I think that the largest deal that I've ever funded, let's see, I'm trying to think. Credit union, I did some higher amounts just because it was like a true commercial lender. But here, it's definitely at right over 2 million. I think is what I've done.
And for those,
That's
those
awesome.
that don't understand, so if someone's looking to buy a property that needs work, you'll come in, lend the money for both the purchase and the renovation, the rehab, and then it converts to like a traditional mortgage afterwards.
So sort of.
Yeah, or are you guys more of a bridge?
We actually have both. So we have the ability internally to take what we do on our fix and flip new construction programs. It's the same lending parameters, the same property types, to then also convert it to almost like a buy and hold mortgage. So it's a 30-year fixed. It's based on DSCR, and we're going to also see, like while we're underwriting, we're going to make sure that we have that option. But some borrowers, they can qualify for an actual takeout with like agency funding, like go to a bank or credit union, and that's perfectly fine. We're not greedy. If you want to go there, that's absolutely acceptable. But the nice thing is that a lot of the people that we work with are self-employed borrowers. A lot of them are full-time investors. So on purpose, their tax returns aren't showing that they make as much money as a bank or credit union might want to see. So things come into play like debt to income and or maxing out on the Fannie maximum of 10 units at one time, whatever that may be. So because a lot of the borrowers that come to us are in that situation and we don't care about your tax returns, I will never ask you for one, and we don't care about your debt to income, and there's no limit as long as it makes sense. Like we write individually to each project. We don't need to look at global cash flow like a lot of places do because that's not how we operate. A lot of times they don't end up going to agency or bank debt because they need to stay with us. We have that ability to then refinance into a DSCR with the same lending parameters, if not asking for all that jazz. And let me tell you, I was in the space, a true commercial lending space, and the things that I had to ask for, sometimes I felt like I was asking for their firstborn child on top of everything. Like, it is a lot. So when someone says they want to do that, by all means, I don't argue. If you want to go through that, great. And if you can qualify, absolutely. But there's either people who can't or there's people who don't want to. And those are the people that I can shine for.
Well, it's very difficult to go the conventional way, right? I think you said it like makes sense, right? Like I've been preaching this for years. It just makes sense lending, right? That whole debt to income model is absolutely broken in my opinion. I mean, and if you are an investor, especially, right, you need to be able to be nimble, move quickly, and you can't do that often on a regular bank timeline. So lenders like yourself become really valuable. So I've been on both sides of this. I actually just arranged a $12 million private construction loan for somebody actually in New Mexico. So I've been seeing that side of it, right? So I was involved in 2020, 2021. So I know at the time I've seen as high as on a fix and flip 80, 90%. 90% of the work, and they'd go off to like the after repair value, and rates were at the time like 9%. I mean, what are you seeing now? Is it gotten crazy? Have the LTVs changed a lot?
I mean, I would say that if you were to talk to me a couple years ago, before I think it was the middle of 2022 when things started kind of starting to tighten up. Back then, it was like it felt like free money, and it kind of was, considering like the past that our nation's been through, and probably what we're going to see going forward.
Mm-hmm.
I wouldn't necessarily say. I mean, the rates again aren't reliant on what the true like the residential mortgage market's doing. So you're not going to see the fluctuation in our rates like you would if you're going to go buy your primary or secondary home. People are always like, what are the rates doing today? I'm like, they're the same as they were last week. Like, we don't change them like people change their underwear. Like, they pretty much stay consistent. We have a really good capital markets team. We're looking to get a certain return in the REIT that owns us, and that's what we're focusing on. But then again, it's not that they're not the same as they were a couple of years ago. They're definitely higher, but the way that we underwrite is based on experience. You're going to get better rates and leverages on the more projects that you've done. It's almost like a way of kind of proving your worth. We definitely like the more that you've done, the easier it is to trust that you can complete the project, because it's in everybody's best interest for you to make money, especially in a rehab or new construction. So we're definitely going to make sure that's there. And then even if you're just going into a buy and hold, we want to make sure that your income generated covers your expenses, because the last thing that Lima One wants to do is take over your property in the end. Like, that's a huge difference between us and like other like true hard money lenders. Is we want to earn your interest, not take over your property. But as far as like what rates and leverages look like, we try to be the top of the barrel. Is the top of the barrel the best? Let's go with top of the barrel. Our goal is to be the premier place that residential real estate investors come to for financing. So especially if you've got some experience, like that's really where we shine. We can go all the way up to 92.5% blended loan to cost, which is huge. And we will give like a minimum of like barely 10% down, especially for our higher borrowers. And our interest rates aren't really that bad. I mean, if you're looking at what prime is right now and you compare it to like what banks are offering and whatnot, and what your credit card statement is probably looking like right now, our base of 9% is nothing. And their interest only,
That's not bad at all.
They're fantastic. And then the other thing that really we understand too about real estate investors is it's rarely about the rate. Like, in the end, rate is important. But when I'm talking to a true investor or somebody who I know knows what they're talking about, like, if rate doesn't ever come up in the conversation, that's actually a good sign for me. Not that we don't have a great rate, but because I know it's not about that when they're looking at a project. They're looking at how quickly can you fund? What kind of money are you giving me at the closing table? How am I getting my money during the project? And how quickly can I finish this and not have it, not have to pay more than necessary? And one of the great things about Lima One is that we do not outsource our construction management. We actually don't even outsource our servicing. So if you came to us and you were just a buy and hold guy or girl, you would get your loan with us and you would still have the same people at Lima One talking to you for the rest of that 5, 10, however long you kept that 30-year loan. So it's huge, because a lot of times you're doing that and then the company is selling it off, and I have this my own.
You don't sell off your primary,
nope,
your
don't
permanent
sell them
loans
off. So you're stuck. You're with us. We service them for you, and that's it. You're stuck with us. Basically, is how I like to say it.
You keep saying residential loan, so I just want to, for the viewers, where does residential as defined for Lima One start and end? Up to how many families?
So we do all of our real estate that we focus on has a residential aspect to it. That being said, it's not for the borrower to move into. So it's always non-owner occupied. So if you're going to buy and hold, that means somebody else is moving into it. You're renting it out. And then if you're going to do a rehab project, you're either going to sell it for a profit or you're going to refinance in that same type of a loan where you're not moving into it. Same with ground up new construction, et cetera. So we'll do 1 to 4 families. We'll do townhouse PUD, trying to think of what else, condos. So land by itself, no. That's like one of the most asked for products. If you go on Facebook, I'm like on there all the time prospecting, and people are constantly, I know I said Facebook, it makes me old, but it's a good place to find some information if anybody wants a tidbit. The true land lenders are very hard to find. I usually just say like go to your local bank or whatnot. But we do finance part of the land plus new construction if you're doing a new construction loan with us. So I always say, yeah, if you've got a budget and you want us to do, all encompassing, we'll do that for you. But now I'm trying to remember what the actual question was. Oh, property types. Yes. So
1 to 4 family, you'll do townhouses.
Yep, townhouses, PUDs, condos. We will do 5 to 9 on our fix and flip if you have the relevant or applicable experience. And then we do have that multifamily bridge loan that I talked about. It's a little bit different. I find it to be kind of like one of our aces in the hole, so to speak, because other lenders in our space, because Lima One is not alone. There are other lenders that do the similar. They'll kind of stick to the 1 to 4, all the things I just mentioned. But outside of that, that's kind of it. We have curated a special multifamily program that's kind of more like a true commercial lending kind of a scenario where if you talk to an appraiser, or if you talk to someone who knows any better, like anything more than 5 units or 4 units is considered commercial real estate. 5 to 9 is like it's a weird space where you can kind of sometimes do more traditional mortgage stuff. It's not quite the multifamily, but it's still technically considered multifamily. We'll do up to, again, 10 million right now is like about what we've been seeing in a multifamily bridge loan. It's stable. You can do it either as stabilized. So that means like you're just buying and holding, or refinancing. It's just, that's it. Like it's the money, it's bridge, it's interest only. Max of 3 years. So you do have to have a takeout, and we'll underwrite to that, making sure that there's a place for you to bring it if you need to refinance or whatnot. But we'll also do like what we consider a value add bridge. And that one seems to be the most popular because if anyone is in the business, they know that the multifamily properties across the US right now are really, they're needing a lot of work. People aren't building as many now. And the ones that were built, they are at the place now that they need like new roofs, they need rental, their income needs to be increased for different reasons. Maybe it hasn't caught up to the market. Just like wear and tear, little things that are keeping it from really performing to its max capability. And a lot of times, like Freddie, for instance, won't do anything with that because it's not up to par. So we're going to be like that stepping stone, come in and give you acquisition funding or refinance if you already own, and then also up to 85% loan to cost of a CapEx budget. So that's really designed to get it back in working order, allows you to increase the rents where you need to, if that makes sense, to really get it into a place where then you can take it to a Freddie takeout or similar agency funding. And that's huge right now because there's people all over the US that are trying to figure out how we can increase housing. There's a shortage. There has been for years, and we don't really see it going away anytime soon. So that particular space, that can be up 5+ units, but those are $1 million or more loan amounts. That particular space is really special to us.
What do terms like that look like? I'm very curious. I actually just got back from a convention that was pretty much all syndicators and mostly people in the multifamily space. And the multifamily space is in flux right now across the country. So I could see that being a really interesting program, to say the least. So what does like your LTVs look like on that? I'm just
again, we'll do loan to cost up to 85%, and costs really, it's one of those things that if you're not in the business or if you're fairly new, cost is one of the biggest things to try and wrap your head around. Like I could do a whole podcast almost honestly on like trying to explain how cost works and to wrap your head around it. But essentially, yes, if you're familiar with what that looks like, up to 85%, that's our cap. A lot of other lenders are maxing out at like 60-65%. So we have a lot of wiggle room there that you might not see other places. It's a bridge loan, so it's not permanent financing. It is interest only. Our standard term is 2 years. You can elect for a third if that makes the most sense based on your goals for that property or for that overall subject. And then interest rates aren't like the greatest, but in this case, it's not about the interest rate. Again, it's about what the end goal is, where you're going to be bringing that property in the end. It's going to be hopefully making you more income. Your NOI is going to go up at the end of the project. So then you can take it to like a traditional takeout and you're going to get much better rate because that's what they're made for. And you're going to be making more money, which is the whole goal of the people we work with.
Are rates like that spread based, and you're going off an index, or are they
So
or
it
is
is
it a fixed
fixed,
kind of
but it's
rate
going to
when
be
going
based
into
off
the
of
loan?
the index that we're using at the time.
What do you use as the index? Just out of
Well,
curiosity.
I don't want to say because it could change tomorrow. So like,
Oh, really?
yes, our multifamily
Interesting.
division is always trying to make things like better. And like I could give you a quote, but I want this to be relevant for like if somebody watched this in like 6 months. But it is like we do have an index that we use, and I'm going to say it's not the greatest, but it's not terrible. You won't pay more than 13%. Let's just put it that way. And then
Because I just crossed paths with Sofra, I guess is how you say it, and I've never seen that index before. And they said that they fluctuate indexes too, which I didn't know that was common. That's interesting.
yeah, so like again, because the index is not fixed, the rate could depends on when you ask for a quote. But once we underwrite you, then we do fix that rate. So that margin is going to be set. That we're not going to go based on the index. So whatever those 2 or 3 years you have, it's going to be a fixed rate. So you're good to go going forward. But it's just because the margin's constantly, or excuse me, the index is constantly changing. Like I want it to be relevant to whoever's watching this going forward.
Are you seeing a lot of multifamily borrowers get to that point? I mean, I don't know if they've been far out enough where you're seeing people get to the position of the end of the 2 years or 3 years, and now they're not in a position to refinance, especially. I mean, because I could see somebody that was in it 18 months ago. It's a very different landscape, and I don't think anyone thought it was going to get bad this quickly. So, I mean, I saw at the show, I couldn't believe how many multifamily operators are in serious trouble and we're looking to be bailed out. So I could see that being a tough space.
It is, and things have definitely changed, especially if you have CapEx and you're having to worry about like the budget being applicable from what it was when you first did it.
Oh, that's a good point. I didn't even think of that. That's a good point.
Yeah, so your budget is definitely different than it was a year or 2 years ago. Your timing is different. So it's not, I don't know how to really put it. It's definitely a different landscape now, but we really do as good of a job as possible of honing down like what that's going to look like in 2 to 3 years. Again, nobody has a crystal ball. We don't know. But I think that right now is really the easiest time to figure it out than it was like maybe a year or two ago, because things have been a little bit more consistent lately. And we are, again, still underwriting to a Freddie, most likely Freddie takeout, where the rates are a little bit more palatable for long term. And we're making sure that, again, this goes back to just not just the multifamily, but in general. In this industry, we're seeing a tightening on what we will lend to according to an ARV value. And that's hard for investors right now because they're like, no, I know it's going to be worth this. I know it's going to be worth that. But we really have to go based off of the fact that even though it wasn't a huge inflation, the last couple of years have inflated property values a little bit more than what was normal. And we don't necessarily think that it's too high. But that being said, we don't really have, this is what it's done in the past. Like what we're going through now, there's no precedent for it necessarily.
Very true.
So we have to kind of hedge our bets as best as possible. We want to, like I said, be the premier investor or premier space for you to come to as an investor, but we also want to make sure that we're still there to come to in the next couple of years. And that's one of the reasons why we've been successful, is because we're really trying to give you as much as we possibly can, but also make sure that we're not putting ourselves in a bad spot where we have to be taken over like some of the Civics or the Facos of the world or what have you. We want to be the same company now in a couple of years, if not better. So what you're seeing, instead of like upfront money necessarily being, it's pretty similar to what it was in the past, you're seeing a little bit more tightening on the ARV. And again, people are like, I don't like that, but we just want to make sure that you have that equity that's necessary for you to be A, profitable, and B, that you don't have to walk away from a project and stick us with the bill. So that's kind of where you see a little bit more of the tightening is on the ARV side, because again, we don't know what's happening. Appraisers are seeing things kind of like slow down a little bit. And then once it gets to that point, we're not going to have these huge property values to rely on for comps down the road.
Yeah.
So we have to be a little bit more conservative there.
And inflation's definitely cooled off from where it was. But with that said, it didn't, in the last report, it didn't go where they were hoping it was. So crazy stat I heard, and I've been saying it nonstop this past couple of days because I can't get over it, but it was, if inflation doesn't do what, a lot of the banks and borrowers are hoping, go to that 2-3% number, 280 banks stand to be out of business in the next 12 months across the country. And
Wow.
some of them are very, very large names. So I thought that was pretty frightening.
Yeah.
Well, think about Allstate and Geico, where they're, all these insurance rates are going up through the roof because, you had this huge inflation in the cost to repair the homes and the cars, and it couldn't keep up with it. These are super sophisticated companies that, listen, I'm sure they should have maybe raised a little bit more over the years, but to just stop and do a 30% raise, we have friends in New York and New Jersey that can't even write new policies anymore because they just like, we're not doing business in the state anymore.
Right.
And it affects the economics.
Hearing that a lot in Florida.
Florida,
Yeah.
Texas is a huge one recently. I don't even know if it's recently. I can just say from experience that Texas has been like total pain in the ass with insurance lately. Definitely Florida for sure. And then you just got other places where like there's a lot of fish in the sea, but they don't always, they don't always have the
100%.
best.
But I think it's great for lender. I think that honestly, one of the safest places is lenders like yourself. Private back lenders that are really doing make sense lending. I think that's what's going to prevail ultimately.
Yeah.
Who when your phone is ringing, what's the most common person calling your phone?
The most common person?
Yeah. Like, is it someone that's just trying to get into the business, or a super sophisticated investor? Like, people that call you and you're underwriting for, most commonly, what are their demographics?
So I go after the sophisticated ones, obviously, because I want to make sure they know that we're an option if they haven't heard of us, especially in the Northeast. Like, we're a little bit less well known than, for instance, like the South and the Southwest. Over there, we're a lot more popular. Not popular, I shouldn't say it like that. Well known, just brand awareness is much higher there and lower where I'm at, which is a good opportunity for me because I get to be the face basically of Lima, the first one. And then if they're like, oh, I heard of Lima One and I know who to call, they're going to call me, which is exactly what I want. But I would say, like, one of the things that I love about Lima, and was one of the reasons why I really liked coming on board here, is we do work with new investors. So we have the ability to work with brand new, I call them baby investors, people who want to just kind of get started in the space. So that's fantastic. But those ones those usually come through referrals or from like prospecting, again, like to Facebook or whatnot, when I'm trying to, see who it is that needs to do what, or talking to my RIAs or other investment like meetup groups or whatnot. You're going to see a lot of the newer people there. I think that the average person that's calling my phone is two. It's I work really closely with mortgage brokers who just do residential mortgages and they need a referral source. That's huge for me because it's not something that either they can do or they're just not familiar with it. So they use us as a resource, or people who like just regular brokers who need something through their clients. Those are going to be more of like the middle ground. Like, they've done a few deals, maybe they're looking to scale. And then the same type of people who I work with directly, like right direct to borrower, they're kind of in the same space. That maybe they've done a couple buy and holds, or maybe they've done their first flip and they want to look at another one, or whatever that may be, what have you. But I also do a lot of networking. So I would say my pool of people calling me is a little different than someone who just kind of sits and waits for the phone to call, if that makes sense. I'm always like putting myself out there and asking for referrals and seeing, who do you know and who's wanting to get involved, and doing educational events or talking all the time. Like, I love doing that, because at least if one person has this idea in the back of their head that, hey, I can actually do this, and there's an avenue for me, then like that's huge. So I love to like make sure that I'm out there and I'm accessible, and also the whole, what's the word I'm looking for? Not learning and engagement, but just being a resource, I guess. Teaching people,
yeah, of course,
telling them what they need to know.
It's the whole reason
my biggest jam is, my biggest thing is like, if someone's like, I want to get into investing, what do I need to do? And I'm like, I will tell you. I literally have a whole PowerPoint on it if you really want me to go through it for you. But I'm going to tell you, here's your steps. I'm the first person to say, here's the questions to ask and get answered. If you don't go with Lima, for instance, but you find someone else and you get on your investment journey in real estate, I'm going to be your biggest cheerleader. You don't have to use me. That's fine. I just think that this realm of business is like so important. Like people talk to me all the time about, oh, you're saving for your kids' college. And I have 2 kids. They're very small. So I have a long time to save for their college. And my response to them always is, no, I am not saving for their college. If they want to go to college, they can do it on their own like I did. I am saving for their first home. Because when my kids are old enough to be able to get into real estate, I don't know if it will be accessible. That's
barely
my biggest
accessible
fear.
now.
Correct. And so my goal not only is to build like passive income and a portfolio that can kind of be another, Forbes says to have 8 different avenues of income, so that if one fails, you have the other 7 to back up, rely on. So that's checking that box for me. But worst case scenario, they get to the age where they can buy a house, and guess what? They don't have to buy one. I just give them one of the ones that I've already built for them, and built. Maybe I bought it or I truly built it, whatever that looks like. But that's what I'm working for. It's not their school. It's so that they have a place to lay their head when they're at that age, and that's not a hurdle for them. Because let me tell you, I don't want them staying in my basement.
I love it.
Yeah.
Amy, this was an awesome conversation. And to go back to networking, that's how you and I met.
Yes.
And listen, I think that what your bank does is unique. I think there's a need for it. I think it's thinking out of the box, and everyone is really frustrated with traditional financing. Listen, kudos to you and to Lima One.
Thank you.
And we'd love to have you come back on and talk a little more and about the market as it's diversely changing every single day.
Yes,
we'll be sure
absolutely.
to put everybody, all your contact info, and maybe some of the loan programs you're doing, because I think that's super interesting for people. So thank you so much for being on here. We really appreciate it. And this was a lot of fun.
Yeah, it was my pleasure.
Thank you so much, Amy. Speak to you soon.
All right, thank you.
Take care.